Welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Jack Bishop, investment manager based out of our Manchester office, and this week I'm pleased to be joined by regular commentator and head of fixed interest research, Richard Carter, and Ben Barringer, one of our global equity research analysts covering the tech sector. A very good morning to you both. Last week, we had another heatwave, an eclipse, and almost 10,000 votes for a bin to represent the people of Clacton. And equity markets continue to hover around all-time highs. However, a very different story in the bond market, with yields higher across the board, particularly at the long end. And the data that we saw last week, the urgency of a rate hike from the Fed may have cooled a little. So, Richard, let's dive straight in. You spoke last week on the podcast about the weaker than expected jobs data, which is half of the Fed's dual mandate, as we know. Maximum employment and price stability. This week, we had the prices elements of the US CPI report out for July, coming broadly as expected, 0.1% month on month and 3.4% year on year. Second consecutive report, which is relatively benign. So what's your take on the Fed's current stance? Are they right to stay on hold despite the market pricing rate hikes? As Walsh found himself basically in the exact same position that Powell did, too high inflation and a kind of an unclear employment backdrop. And I know we had PPI as well, probably worth touching on.
Yeah, I think so. I think he's in a similar position to Powell, but maybe Powell was a bit better at communicating and giving his views on the path and all the rest of it. And I think reassuring the bond market that, you know, if push came to shove, they would hike rates, and it was pretty clear what they were looking at. And I think with Walsh, maybe this will turn out to be the right thing in the long term, but he's basically letting the market guess for themselves about what the direction of policy is, and I'm not sure that's particularly helpful at the moment. And it's also, I mean, given what you said, it's understandable that there's a bit of a debate, a bit of a split on the Fed committee. I mean, we have the same in the Bank of England, the MPC. You know, there's normally a split every month, and people are fine with that. And it's perhaps it causes a bigger stir when the Fed has that issue, but we should probably accept that, like you say, the inflation numbers. Okay, they haven't been terrible, but 3.5% inflation is still not really ideal. And then on the other hand, you've had slightly weaker jobs data, so it is a pretty tough call for them. I think they've just about got it right. But if you've still got a situation in 6 months' time that Middle Eastern problems are rumbling on and inflation's still sticky and the oil price is up around sort of $90 a barrel. I think bond markets will want to see some, maybe some tightening from the Fed, because otherwise you're in danger of just sort of letting the inflation cat out of the bag again. So, yeah, it's not an easy situation for them at the moment, but Walsh could certainly do better to kind of reassure markets they know where things are going.
Yeah, I think we'll have the Fed minutes this week, which might give a bit more colour to the whole situation, I guess. And sticking with kind of bonds and borrowing costs, they were in the focus for the US last week. So we had two Treasury auctions for 30-year bonds, which was sold at 5.22%. So highest, I think, since 2001, and then a 10-year Treasury auction as well. That was at the highest yield since 2007. Still a decent cover on them, so there is appetite there from them, but clearly they need to pay up for it. And then I think there's another auction as well coming up this week, so we're locking in that ever higher debt servicing costs and then the feedback loop of that. So are you concerned about that in terms of the US's fiscal position, given the deficit and, as we mentioned, then the persistently elevated inflation?
Yeah, definitely. I mean, I think, you're spot on, elevated inflation, persistent inflation, that's a part of it. And then there's all the, the government borrowing, the deficits, plus, as Ben's going to come on, sort of might talk about a lot of longer dated issuance coming out of the corporate bond market as well, which has all got to be absorbed. I think for me, the problem with the US is that, here we have this constant debate about what can we do to, reform government spending, get the welfare bill down, the fiscal rules, how are we going to. And all, you could say a lot of it's sort of smoke and mirrors and all the rest of it, and the problem's not going to go away because of the aging population. But at least we're having that kind of discussion, and most parties seem to have learnt the lesson of the whole Liz Truss thing. In the US, it doesn't even seem to be much of a debate about how to get a deficit down, and you're running a 6% deficit at a time when the economy is doing really well. You're supposed to run a 6% deficit when you're at war or when there's a recession on, you've got to pay lots of unemployment benefit. So it is a concern. I mean, America does have this privilege, obviously, of people just want to buy dollars, want to own dollars, and want to buy US treasuries. But the borrowing costs keep going up and up, and it's obviously it sort of crowds out all the other things you need to spend money on, whether it's health or social security or military or whatever it is. So yes, I do worry about it, and we should we should remember this is a global issue for a lot of governments. There's too much debt, and they need to kind of take measures to kind of get it under control.
Yeah, agreed, which kind of segues nicely into the UK, I guess. Not often we hear good news on the growth front here in the UK. So we had economic growth out for Q2. The economy grew by 0.4%, and that builds on the 0.6 that we saw in Q1. So technically, that makes the UK the fastest growing economy in the G7 in the first half of the year. Does, however, follow a pattern where we have that strong or decent growth in the first half and then tails off as we approach the budget when there's the fears of tax rises, etc. I think we saw from Jamie Dimon over the weekend kind of lobbying essentially the new chancellor to refrain from additional tax on banks. So Burnham, he has signalled higher spending. Are we at risk of repeating the same pattern? And what's the assessment, in your view, of the current economic performance, mindful of this week? I think we'll have employment data, the inflation data, and PMIs.
Yeah, I think it's we should welcome it because it's at least it's it's not much, but at least it's positive. I think you're spot on. It could all be a bit of a. I mean, often these numbers get revised away and all the rest of it. But clearly, there's been a boost from the World Cup, and that's probably going to erode as we go on through the year. So and then exactly. We've got the budget coming up, and people tend to sort of hold back a little bit and wait and see what happens with that. So yes, it's quite possible. I mean, I think we just kind of want to see stability and a sort of sensible management from the government, and not keep chopping and changing things and reversing course every 5 minutes and then coming up with new taxes, and then that's not helpful. And I mean, I think that's in some ways, Keir Starmer's not going to get any benefit from that now, but in some ways that was his approach, and it seems to have sort of borne fruit a little bit. I think Burnham, for all his sort of headline measures and these little announcements, they don't really add up to a hill of beans, to be quite honest. So far, it's all pretty small beer. So hopefully they won't make the mistake in the budget of kind of making dramatic changes. But yeah, at least there's a little bit of growth in the UK.
That's it. Got to look for the positive. Thanks, Richard. So, Ben, thanks for joining us. We'll turn to you now. We're towards the end of results season. We've heard from a lot of companies under your coverage. I think it'd be useful if we could just have a kind of summary of the key themes that you've seen, whether that's the bottlenecks in computing, the AI supply chain, CapEx, earnings growth. And really importantly, I think, are we beginning to see any proof that those huge sums invested by the hyperscalers are starting to pay off and translating into revenue? And really how maybe we're invested across the tech sector. So it's not just Mag 7, the hyperscalers. Are we more diversified now, probably across the tech stack?
Yeah, great. Thank you. And good morning, Jack. So look, in summary, the US had a good earnings season. The average company beat by 90% of companies beat. That's compared to a normal of around 70, 75. US are pretty good at managing expectations. But within the tech sector, it continues to be a strong earnings season. And demand in general is outstripping supply, particularly in semis still. You asked about bottlenecks. Yeah, there are still bottlenecks in CPU, a little bit less in GPU. So that's NVIDIA's space, but CPU companies like Intel and AMD. Memory continues to remain, very demand lead and supply short. Power semiconductors, that's again seeing good growth. And then all of this stuff has to be built by machines. So those machines, semi-cap equipment, those are also seeing strong positive revisions in what we call WFE, so wafer fab equipment spending, which we expect will probably be up about 30% this year and probably 25% next year. So still a very good resilient earnings backdrop. You asked about return on invested capital, and that is the absolute linchpin of what people are interested in these results. So obviously there's a huge amount of capex going into the ground, the big hyperscalers. If you include SpaceX and a few others, it's going to be over $1 trillion next year by most forecasts, and it's going to grow this year by 94%, the capex, and next year by about 47%. In 2028, that number is around 14. So we are seeing a slowing. And so investors are sort of trying to work out how impactful that slowing of growth is going to be. And so there's a lot of nervousness after, well, what did we see in Q2? Semis up over 80, almost 100%. So there was a little bit of profit taking into the summer. People, I think of it as de-risking your portfolio before you go on holiday. So that capex continues to remain a strong and growing, although slightly slowing. And we saw some positive revisions in that capex through Q2. We saw positive revisions from Google. Microsoft held flat, a small uptick from Meta, and a modest uptick from AWS. Your question, though, is absolutely right. Like, that's the denominator. What's happening to the numerator of return on invested capital? And you are seeing accelerating revenue growth at the cloud providers. So Microsoft Azure grew 43%. That's 3% better than people expected. AWS grew 37%. I think that's about 5% faster than people expected. And Google at 87%. Although the Google numbers are a little bit clouded because they've started to include chip sales of their TPU in that number, but still a very strong number from all of those. And that really helps people get comfortable with the returns on invested capital. That plus increasing enterprise adoption. I spend a lot of time talking to CIOs, and we're moving from pilot projects into full implementations. And you saw that in the Microsoft numbers with Copilot really seeing accelerating revenue. Now, Copilot historically has not been the best product, but it is a very enterprise-friendly, enterprise-safe product. And so, yeah, that's led to good unit economics. The market is still in a little bit of a quandary, though, because there was good returns coming from that capex, but when you look at earnings growth, increasingly depreciation from the capex affects that, and then obviously free cash flow, which is directly impacted by capex, that's turning negative in some cases. And so the market is trying to look through the cash flow and earnings dip through to the more positive sort of unit economics that are definitely going to be produced, good revenue growth, good margins from this. So yeah, look, overall a good earnings season. Hopefully that's covered everything. What else do you want me to talk about?
Yeah, so we were just talking about as well kind of how we're diversified. So I guess this kind of links in my next question really about memory as well. So it's not just the hyperscalers. We've got memory, which is a key focus. I know we've seen quite wild swings as well in share prices of big players. And historically, it's been a volatile subsector, subject to boom and bust. But you've talked as well about the kind of emergence of these long-term agreements that locks in that supply certainty. So maybe just touch on how we're kind of positioned, and particularly on memory, positive on memory, concerned about the concentration with a small number, particularly in Asia, maybe.
Okay, that's great. Yeah. So yeah, the key conclusion, we've been very overweight semis and underweight hardware and underweight software. The key conclusion from the Q2 numbers is that because you're seeing the AI show up not just in semiconductors, but now increasingly in hyperscalers and in some cases software, we're trying to balance that. And so we've gone very slightly less keen on semis, but much more keen or reduce that underweight in sort of the hyperscalers and the software companies. So that we're trying to provide more balance, if you will, as we see the AI diffusion or adoption broaden a little bit through the economy. So that's we're trying to reflect reality into our portfolios, which I think is always a good thing. On to your questions about memory. Yeah, look, memory is always a difficult area because it's incredibly sensitive to supply and demand, right? And demand can be quite volatile because of macro conditions, but then supply is also quite chunky. You know, it takes you 2, maybe 3 years to build new capacity in terms of a new fab, and so these chunks sort of come on. And what you've seen is, in terms of demand, because AI is very memory intensive. When I ask ChatGPT about things, it remembers that I've got, 2 6-year-old twins, and it remembers that I live in Brighton, and it remembers that I'm a global tech analyst, and so forth. All of that memory, shows up in memory chips. And so demand for AI chips, for memory chips from AI has been very, very strong. That's actually in some cases crowding out other industries. Look, smartphone prices are going to rise because of the increasing memory prices, and that causes demand destruction in smartphones. Look, overall, we have seen very strong increases in the memory price. That's led to very good profitability at the memory companies. People are worried a little bit about a few things. One, the year-on-year acceleration of the price is no longer accelerating at a sort of exponential rate. It's starting to roll over. People are worried about that. I'm a bit more sanguine about that. I think as long as the memory price is going up, that's positive for memory stocks. Second of all, Chinese competition. We saw the IPO of CXMT, which is a DRAM provider in China. Remember that the DRAM market is 3 players: Micron, Samsung, and Hynix, and then this fourth player, CXMT, which is about 7% of chips of memory chips. They might disrupt the pricing, so that's something to think about and maybe worry about. And then finally, you touched on long-term agreements. The memory industry, because essentially people trade off the spot price. There are some contracts, but there aren't long-term agreements because of this increase in demand that you're seeing and a shortage of memory chips. The hyperscalers are looking to sign long-term agreements to lock in the supply of the memory that they need. That's very good for the memory companies that see through a cycle, see very volatile margins and pricing. But the stock market is still a little bit skeptical about how much those long-term agreements stick. So, and also to a certain extent, you are by locking in the price today, you're giving away any potential upside as well. But overall, we remain reasonably constructive on the memory industry, although we do actually have a preference for the hard disk drive makers. So we're like a company called Seagate, because we think that they are less volatile than the DRAM market. So yeah, look, lots in the memory industry. As I say, it's the most cyclical of all the semis markets, and we keep a very close eye on it, but we remain reasonably positive on memory for now. But it will be one of the first ones to roll over if things go south. Thanks.
No, that's really helpful, Ben. So yeah, one we'll keep an eye on. And then finally, just one story that caught my eye, which I know you've kind of talked about already across the firm, is Nvidia's 500 billion AI financing deal with a consortium of the likes of Apollo, Blackstone, etc. And that's for kind of AI infrastructure development. So normally we associate Nvidia with building the actual chips and the infrastructure and software that goes with it. Here, again, you correct me if I'm wrong, but there seems to be kind of financing in a way, smaller players to encourage them to buy more of their products. What's the story here, and what's your thought? Is this a red flag in terms of a threat to Nvidia, or should they be doing this? What's your take on it?
Yeah, look, it's not a red flag, but it's certainly not a great look, is the way I think about it. The context here is that because of the great profits that have been made in AI, and people are on bubble watch, including me, there's increasingly news headlines around things that don't look that great. And I would look at this financing deal that you're talking about, the credit markets, as Richard was talking about earlier, spreads, and there's a lot of debt issuance happening in the US debt market. Again, not a red flag, but something we watch, particularly the CDSs. And then there's also political backlash, which I won't go into at the moment, but increasing, opposition to data center builds, which we watch as well. But onto this 500 billion. I would much prefer that Nvidia used its almost 400 billion of operating profit it's going to create next year to just buy back stock. But when you get new industries, there are certain hurdles and things that have to be developed. And one of them is the financing that underlies some of these data center builds. And to give you an example, CoreWeave in 2023, its cost of borrowing was around 12-13%. As the industry has matured, that number's coming down to sort of 7 or 6%. And that's before these measures. This is another attempt by Jensen to encourage growth in his ecosystem and competition. It basically means, CoreWeave and Nebius aren't as disadvantaged as some of the big hyperscalers, but because the CoreWeave and Nebius don't have the balance sheet. So he's trying to sort of level the playing field, if you will. Now, of course, that's self-serving because it means he sells more GPUs to these new people. But he is it's actually restricted to 25% of this 500 billion. So it's actually only 125 billion, which in the context of a $5 trillion company is not a huge amount, but it is, it's definitely worth paying attention to. And so what is happening is he is essentially backstopping some of this financing by saying, in the event that this goes south, he will take the GPUs as collateral. Those GPUs have a revenue stream because you can work out what they are being rented out at, and that is giving them sort of the sort of cash flows to value some of this debt. So it's exposing, the way I think about it is it's exposing Nvidia to more, a more gearing on the upside and on the downside. On the upside in terms of revenues, on the downside in terms of if things go wrong, they're a little bit on the hook, not for the full 500 billion as I say. So yeah, look, it's like I say, it's not a great look, it's not a red flag, but it is something we monitor quite closely. And they haven't released full details of the mathematics behind it, but I think it's quite the economics look quite positive of them doing this deal, particularly if they innovate fast and their older products continue to have good residual values essentially. So hopefully that sort of covers it. Just to close though, we still remain reasonably constructive around the AI trade. Supply and demand balance is still, supply restricted. Return on invested capital and enterprise adoption continues to look pretty positive. And also valuations and growth look reasonably in check. We're not at historic bubble type valuations as well. However, things like we've just talked about keep us a little bit muted. And so we like to be in good quality companies and are quite selective and we're not staggeringly overweight. And so we want to be participating, but not taking too much risk. And 'twas ever so, we're trying to make good risk adjusted returns for clients.
Good. No situational awareness risk with us. So thanks, Ben. Thanks, Richard, for those great insights, and to all of you for listening. Did you enjoy the discussion on our podcast today? We'd love to hear from our listeners. So please review the show now, wherever you're listening, share it on your socials and tag us at Quilter Cheviot. And to make sure you don't miss a future episode, tap the subscribe button. We'll be back next week. In the meantime, you can head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and any upcoming webinars and events that we might have on our website or on our social media pages. And then finally, we do like to hear from our listeners. So if there's a question you'd like to ask one of our experts for our next podcast, please submit them via the weekly comments page on our website. And that's it for today. So thank you both to Richard and Ben for your time, and to all of you for listening. We'll see you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.